In this session, we are going to talk about order types. There are three main types of order to take note of. First being the market order, followed by limit order and the stop order. A market order is an order to buy or sell at the best available price. Generally, this order will be executed immediately. For example, if the FKRI November 15 quote is as such, being the best bidder at 1,720.5 points and the best offer at 1,721 points. If we were to buy from the market, we will be taking it from the best offer at 1,721 points. If we were to sell, we will sell at market to the best bidder at 1,720.5 points. Now for the question, if you want to buy FKLI at market price, what will the price be executed at? The answer, it is at 1,721 points from the best offer. Moving on to the limit order. A limit order is an order to buy or sell at a specific price or better. A buy limit usually is executed at a specified limit price or lower. A sell limit, however, can only be executed at a specific limit price or higher. This means that if you want to buy a contract or a stock or whatever asset, we will hope to purchase it below market price. And if you will want to sell, we will hope to sell it above market price. The higher the better. This goes with the concept of buy low, sell high. If you will want to buy and want to put a buy limit, the lower the better. If you want to sell an asset or an equity or futures in this case, the higher the better. Let's look at an example for the limit order. Assuming we see the same quote here of the best bid being 1,720.5 points and the best offer being at 1,721 points. If we were to execute a buy limit order, it should be below the market order of 1,721 points. That is what the market is doing now. So if you want to queue, for example, we queue at 1,715. We put a buy limit at 1,715. This means that only if the market goes down and the price reaches 1,715 or better, only therefore the order will be filled. And this happens vice versa for sell limit. Lastly, let's move on to the stop order. A stop order is basically a stop loss order. It is an order to close or cut your position when it reaches a certain price. This is designed to limit an investor's loss on a position. So, for example, if you have put a sell order, if you're holding a short position, you can put a buy stop order above the market price. This means that if the market is going up, it will be against your favor and you would buy back. You put a buy stop order to close out your position. And if you're holding a long position, you should put a sell stop order below the market price. This means that if the price starts going down against your favor, you will be stopped out once you hit your stop price. Let's look at an example. A sell stop order. If you're holding a long one lot FKLI at 1,750 points, you hope to make a profit when the prices goes up. However, if the prices starts going down, you will be making a loss, and you want to limit the loss by putting a sell stop order. So for example, you decided to put a stop loss at 5 points down, you should put a self-stop order at 1745. This means that when the market reaches 1745 points or the next best price, your order will be executed, limiting your losses to only 5 points. Lastly, let's talk about order durations. From the platform, you'll be able to see there are several types of orders: GTC, GTD, and so on and so forth. For a limit or stop order without indication, it means that the orders are valid only until the end of the day. If you wish for your order to be kept going on, please use the GTC order or good till cancel order. This means that the order is valid until you have cancelled them manually. You can also use the GTD order, which stands for good till date, and select a date there. This means that the order will be valid until a specified date. This concludes the session for order types.